Hello, I'm back on the air. You're tuned in to 7. And I'm your stock market crash test dummy, Matthew Mills. And you've joined us for the latest of our 7 lecture series, The Trust Triangulation. Now, during the period leading up to this particular lecture, a sunnier disposition seemed to be sort of settling over and infusing investment markets. And it looked as if we were kind of clawing back a lot of the lost ground over the previous sort of 6 months or so. But then in the last few weeks, we've seen a fairly sharp downturn following comments by the chap in this picture here, who's the chair of the Federal Reserve, a fellow called Jerome Powell. And specifically, during a meeting at a place called Jackson Hole, which is in Wyoming, and I think is the bit made famous from Close Encounters, but somebody can correct me on that one. He basically articulated fairly succinctly the central bank would do what is required to bring inflation under control and to stabilize the economy. Now, Powell's comments were broadly interpreted by investors as an intention to raise interest rates. And that's an assumption supported in no small part by the fact that the single most popular question on Google shortly after he made his comments was, what happens to my investments if interest rates go up? And I think that's actually sort of meaningful information. Market sentiment then became decidedly bearish and stock market prices followed. Now, just as a quick recap, in case you haven't been to one of these lectures before, the job of a central bank like the Federal Reserve is broadly to keep the economy in a Goldilocks zone. And I've chosen bowls of porridge to explain. It's a really great metaphor for it. The idea is to keep the economy growing at a just right level. Because when we do that, there's lots of good stuff that happens to our health, our wealth, and our happiness. However, if the economy is too cold, that's if it's going backwards in something called recession. We tend to have less money, job losses, and that's not good for us. On the other hand, what seems to be happening at the moment is the economy is running too hot. And that's something we call inflation, where prices are rapidly increasing and becoming increasingly unaffordable. Now, either side of those extremes, the situations get even worse. So when the economy is running really, really cold, really, really badly, it's something we call depression. And lots of really bad stuff happens there. And you can look up on Google what happens in depressions. On the other hand, if economies run really, really hot, then we can end up in a situation called hyperinflation, which I'll talk about a little bit later. And again, that's just as bad. So again, the job of a central bank is to keep the economy in a sort of a Goldilocks zone where everything is just right. Now, one of the principal tools that a central bank will use to influence how hot the economy is running is interest rates. And we can use this example, which is a thermostat or a heating system in a house, to explain that. And basically, interest rates are tweaked up and down to affect the cost of stuff, the price of stuff, and its affordability relative to household budgets, which then feeds back into the economy in the rate at which we're buying stuff and the pressure on prices to escalate, which is what we also refer to as inflation. Now, the thing that got investors worried was that if interest rates go up, it increases the cost of debts in companies, which then reflects into the cost of production to make whatever stuff those companies make. That then bites into expected profits, and then the share price would tend to fall because a company's share price is largely predicated on the basis of the profits that investors expect to make in the longer term. And that's illustrated here in this seesaw diagram of interest rates and how we balance the books. Now, if you extend this metaphor to many hundreds or thousands of shares, then rising interest rates likely to increase cost of debt, broadly speaking, across all companies in the economy. Expected profits are likely to come down in the medium to long term, and so share prices and the value of stock markets generally tends to fall. That's broadly what happened on the expectation interest rates will go up, and investors expected that to bite into profits and share prices to fall. Now, reaching about the midway in this lecture, it's time for an attention break and another stunning statistic brought to you by 7. This is a picture of the $100 trillion banknote produced by the Reserve Bank of Zimbabwe. This is the banknote that has the record for having the greatest number of zeros on it. And this note was printed by the bank as a result of a period of hyperinflation where prices ramped up to the point where people were walking around with wheelbarrows full of one Zimbabwean dollar notes and couldn't do it anymore. So they had to print notes with bigger and bigger denominations to keep up with the rates at which prices were going up. Now, that Zimbabwean banknote that I showed you speaks to why Jerome Powell's comments were so important, because it speaks to the value of money itself and the role that the central bank has in looking after that. So across a dynamic global economy, there are sort of innumerable simultaneous exchanges of goods and services which interact in a complex way on a daily basis. Money serves as a means of keeping account, so who owns what and who owes who what, expressing debt, how much do you owe me, and it's a repository of value to meet that debt. The value of money is basically a promise to pay a share of the economy itself. So a pound note is a share of the UK economy, and a dollar, a US dollar anyway, is a share of the US economy. And while generally unspoken and often never really considered, it might be something you haven't even thought about before you actually came to this lecture, in which case we're delivering real value. Money works because we've all entered into a mutual understanding and that we accept its value. We trust that it fairly and accurately represents a share in the value of the economy, and it can be exchanged as such. And without this trust in money, it's worthless. Ultimately, unless we have trust in the value of money, all the zeros in all the investments that you've got actually are meaningless. Now, the ultimate custodians of our trust in money are the central banks, chaired by the likes of Jerome Powell. In the developed world, government is responsible for raising revenues and spending and taking tax and doing things they do with their policies, while the central banks underpin the security of the nation's wealth and the currency itself. Latterly, the central banks act independently of governments. They've got a separate mandate to ensure the economy remains stable and that we maintain the conditions for sustainable growth, with all the good stuff that comes with that, increasing our wealth, generally associated with positive outcomes such as better health, longevity, and overall improved quality of life. Now, considered from this perspective, inflation poses a fundamental threat to our trust in money. Rapidly escalating prices reduce the buying power or the value of money. In the short term, this progressively diminishes living standards, increases our chance of not being able to meet our debts, and then possibly call into question our ability to sustain home ownership and things like that. But allowed to continue in the longer term, inflation can undermine the provision of basic social services. It can amplify social divisions, and it can even lead to fairly serious social destabilization, the likes of which, if you want to look at it, we saw it in Zimbabwe, for example, and in pre-war Germany. So in this context, faced with levels of price escalation we haven't really seen in a lifetime, themselves the fallout of an unprecedented global economic shutdown as a result of the pandemic, and I'll put a link to basically where that came from a previous lecture, just in case you were naughty enough not to attend. Then Jerome Powell saying that the central bank will do what is required not only seems prudent, but in fact seems vital. So, broadly speaking, Jerome Powell's comments at Jackson Hole seem to be wholly prudent. And we've had a lecture that's explained how that plays into the fundamental value of money. And that even though stock markets and investors might not like the fact that interest rates are going up, it's probably the prudent thing to do. But what have we learned? Well, the value of money, our investments, and everything they underpin depends on trust. A disciplined central bank ensures our future financial security by rigorously applying its mandate, which is to support economic stability. To do so, they must form a credible agent to maintain our fundamental trust in money. And while investors might not like being told remedial action is on its way from the central banks, to contain inflation and all the threats that it could present in the longer term, the reality is that we should actually all feel profoundly reassured that they're there to do so. Now, do you need me to say it again? All right, okay, I'll say it again. This video is intended to inform, to educate, and to entertain, and most certainly does not represent advice in any way, shape, or form. And on that note, we'll see you next time.